Okay, well, thank you everyone for joining us today. I hope you've had a great day so far, and welcome to this presentation. My name is Barbara Da Fonseca. I'm the principal of BDCA Chartered Professional Accountants, and of course, the co-host today is Paul McVean, who is the principal of McVean Tax Professional Corporation. We're both chartered professional accountants with quite a few years underneath our belts involving tax legislation, budget proposals. So of course, here we are today to discuss with you our very important topic. I'm going to share my screen here, which is the Federal Budget 2024 proposal that was just released in April. We are mainly going to be focusing on highlights of the capital gains, inclusion rate changes, as well as some planning issues. Our agenda, oh, there's myself and Paul. Our agenda for today, I will start off the first half of the presentation, focusing on what the budget proposal was in terms of the capital gains impact. What are capital gains? How do we calculate them? What do we do when there are excess losses over the capital gains that are incurred? And what can we do? Some question marks about the proposal. And notice on this slide here, the proposal is stressed, bold, and italics because this is just a proposal. Some tax planning considerations, short-term, long-term, and some valuable information for owners of corporations. Before I dive any further into the presentation, I just want to let everyone know that your microphones have been muted just to avoid any unexpected dogs barking or anything in the background during the presentation. We will be having a question and answer period at the end of the presentation available for everyone. And during the presentation, if you could please use the chat option, which is located on your Zoom menu bar. Please ensure to select everyone so everyone can see what your question is. And this session today is being recorded. It hopefully will be available early next week, if not sooner, together with the slides. Okay, so here we go. Okay, so the budget proposal is effective June 25th, 2024. Right now, capital gains are included in taxable income at the rate of 50%. The proposal that was announced is to increase that inclusion rate to 66.67%, or 2/3. Individuals, however, are being given a bit of a break, whereas their first 250,000 of capital gains will still be included at the 50% rate, and anything over will then be taxed at the 2/3 or 66.67%. Corporations and trusts, no matter if it's 250 or lower or higher, they will have their capital gains included at 66.67%. Again, this is a proposal that is to be effective June 25th, 2024. So everything up to that date as it stands now would be at 50%. And everything after that date for an individual, the full 250 would apply from June 25th onward. It won't be prorated because it's a partial year. The full 250 would apply from June 25th, 2024 forward. Here's an example of the impact of this proposal. Here you can see there's a land and building that was sold for $1 million. You can see there's two columns there. One's showing the impact on individual, because we want to highlight how the first 250,000 will still remain taxed at 50% inclusion rate. And the second side is showing the corporation and trust impact. So both have sold land and building for proceeds of $1 million. It costs $250,000, and a capital gain is incurred of $750,000. Currently, all parties would have to pay tax on $375,000. That's the 50% inclusion rate. Under the new rules, an individual will still pay the 50% on the first 250 and then the 2/3 on the 500,000. You can see the corporation and the trust doesn't matter. They're just going to have to pay the 2/3 inclusion rate. This means that a taxable capital gain under the new rules of 750,000 would be included at 458,000 on an individual's return, and 500,000 would be taxable on the corporations or if the funds are held within the trust. You can see that is a fair bit greater than when it was just 50% inclusion rate. An individual's taxable income would increase by $83,000, and the corporation trust taxable income would increase by $125,000. That is very significant. If we use the high income tax rate of an individual here in Ontario of 53.53%, that's an additional $44,000 in tax that would be paid by an individual. And the corporate trust, the corporation's tax rate at 50.17% on investment income would attract an additional $62,000 in tax. So as you can see, that is a lot of additional tax paid. What's a capital gain? How do we calculate it? Well, it's proceeds minus your cost base and minus outlays and expenses. Why are we showing you this? What sounds like a simple slide is because we want you to be able to reduce your capital gains and know exactly what else you can include in your adjusted cost base. And we don't want you to forget that outlays and expenses on the transaction will reduce your capital gain. Proceeds are the sales amount you have received, perhaps cash right away, but also what you will receive. Sometimes there's a vendor mortgage take back, right? Or sometimes there will be a promissory note receivable where the proceeds will be received sometime next year. So the proceeds is what is received right now and what will be received for that sale. Adjusted cost base is the initial cost of your property. It also includes any legal and realtor costs that you incurred to purchase the property. It also includes renovations over time, capital improvements, additions. These all will end up reducing your capital gain. Outlays and expenses could include finder's fees, commissions, surveyor fees, land transfer taxes. We know in Toronto that's hefty. We don't want to forget those, as well as some advertising fees to sell the property. So a capital gain, or perhaps a loss, is triggered on the disposition of the capital property. As we mentioned, it's the proceeds over the adjusted cost base at the time of the disposition. So what is capital property? Well, typical capital property examples are your portfolio investments in marketable securities, real estate. Perhaps you have a cottage or a second residence, some rental properties, as well as private company shares. Dispositions of property also include when you exchange one property for another, if you gift a property to someone for other than cash, debt settlement, as well as change in use of a property. So some people have principal residence, for example, that is used personally, but they might rent the whole thing out. And that is technically for tax purposes a deemed disposition and a change in use that needs to be reported. Now, we're focusing on taxable capital gains for our presentation here and the impact on you and our friends and partners. What we need to remember that capital gains that are incurred in registered facilities such as a TFSA, a RIF or RSP are non-taxable, so you do not have to worry about those because we're not going to pay tax on those. So it's non-registered capital property. Anything that is sheltered by a TFSA or a registered vehicle such as that is not a focus of this presentation. One thing we do want to remind you of those new flipped property rules that came into play January 1st, 2023. That do not qualify for capital gains. Just a reminder about those flipped property rules. We have a couple of slides to remind you of what those are coming up shortly. And also one thing just to remember, certain capital gains triggered on donations of properties, you do not have to pay tax on, and you actually get a donation tax credit. So of course, you're not paying tax on those, so those are not applicable for today's presentation as well. So when we're talking about capital gains and taxes, we have the full capital gain, and then of course we have that taxable capital gain, what we're including in your taxable income. The taxable capital gain is that original capital gain, like in our example, was 750,000 times the inclusion rate. So that is the 375 that you would include in income. These increases in that inclusion rate is what's triggering more taxes paid. We thought it would be nice to see the history of the capital gains inclusion rates. They started way back when in 1972 and stayed that way at 50% inclusion rate for about 16 years. In 1988 and 1989, it increased to 2/3. 1990 to 1999, and almost another 10 years, it was increased to 3/4, 75%, so almost fully taxable. In 2000, the government started to reduce it again. There was 3 different inclusion rates. Started off at 75, reduced to 2/3, and then finally came back down to 50%, where it has stayed up until June 24, 2024, coming up now. So that's quite a bit. So if you think about it, 2001 to 2024, that's almost 24 years. It's been hovering at 50%. So significant change and impact for all of us. Now, we mentioned in a previous slide that a realized gain occurs when you sell your capital property and you receive cash right away, or perhaps not. You might receive some in the future. We wanted to remind you, as well as think about the impact potentially of this thing called a capital gains reserve. So what is it? A capital gains reserve is something that is available to residents of Canada for sales that are generally between third parties and that, of course, are not exempt from tax. What happens is if you sell a property today, but receive some proceeds in year 2 or year 3, you're allowed to take what's called a capital gains reserve to defer paying tax on that capital gain. So only a portion of it would be taxed this year, the portion that is equal to the amount of cash that you received for that gain. So if you received half the proceeds in the year of sale, then you could record half of that taxable capital gain in your income in year 1 legally and take a reserve. Reserves are then taxable in income the following year, and then you could take a new reserve based on how much proceeds are left to be received in future years. These reserves are optional, but in addition to reminding you that capital gains reserves exist, they're legal, and you can benefit from them, what do you do if you sold a property last year and some proceeds are being received after June 25th, 2024, or even next year? You realized a capital gain in a year where the inclusion rate was 50%. You took your reserve, but now your cash is going to be received, and that capital gain is going to come into your income in a year when the inclusion rate's higher. Are we going to have to pay more tax? And the question is, I don't know. The answer is, we don't know. This is a proposal. So
if I can just speak to that point really quickly.
yes.
In CRA's announcement, they have indicated that this should not be an issue going forward, but we've yet to see draft legislation to know for sure how this is going to work. So we hope this is not a problem, but it's one of the things on the list of we don't know answers yet. So hopefully it'll be okay.
Yes, for sure. So yeah, so there's the capital gains reserves information for you. Capital losses. Although we don't like to incur capital losses, at least we don't have to there's no tax consequences, right, in regards to them. However, not everyone is aware that these capital losses, and it's called an allowable capital loss when you apply the inclusion rate, they can only be used to reduce the current year's capital gains, and anything that's left over is called a net capital loss for the year. Now, these losses can actually be carried back 3 years to recover taxes paid in previous years on capital dispositions, and they can be carried forward indefinitely. So this is one important thing to remember. If you have some capital losses carry forward and you're fears some of these new rules because you have a significant capital gain that you know you're incurring later on this year or next year, you can still use these capital losses to reduce them. Sometimes people will have questions. Well, what happens if I incurred a capital loss and have a net capital loss carry forward from when the inclusion rate was 50%? So as you can see in this on this slide here, there was a capital loss in 2022 that resulted in a net capital loss of 50,000 because of the 50% inclusion rate. Are we only allowed to use 50,000 against a future capital gain that's included in income at 67%? Well, the good news is how the rules have typically been applied and legislated is that the 50,000 will then become the 67,000 that we wanted to reduce the capital gains that are taxable at the same inclusion rate. So it's a little calculation that's done, but at the end of the day, your allowable capital loss will be included at the same inclusion rate to reduce that capital gain that you have to pay tax on. Some of you may have heard of the superficial loss rules. And the superficial loss rules come into play essentially when you sell a capital property and 30 calendar days later, you rebuy the same property. So for example, December 2nd, you sell Microsoft shares. Oh no, that's a bad example. You sell some shares of stock that you own, some capital property, and you incur a loss of 100,000. And you planned it out because you wanted to claim that 100,000 allowable capital loss on your tax return. And you plan on rebuying it on January 4th the next year because you really do want to keep it, the stock. You really have great faith that it's going to rebound and do very well in the future. Well, that loss is classified as a superficial loss and is denied. Superficial loss, what happens is the loss that's actually incurred is added to the ACB of the repurchase of that same or similar property. So these losses you got to keep in mind if you're starting to think, oh, I have a corporation, I'm going to sell some shares in the corporation. I'm going to rebuy them personally. And this way I can benefit from the first 250,000 personally at the 50% rate instead of being stuck at paying tax at the 67% rate in the corporation. So we just wanted to remind you of these rules. Of course, there's other kinds of losses that exist, such as we've all heard of the ABLE, but the extent of this presentation, we're just keeping it simpler, just focusing on our regular capital gains and losses, but that's just something to be reminded that allowable business investment loss rules may come into play, but we won't be getting into that much detail today. A reminder of those flipped property rules that we mentioned. Property, residential property that is held less than 365 days includes rental property and rights to purchase property. The principal residence deduction will not be available. And if you, again, hold the property less than 12 months or 365 days, that income will be deemed to be business income. So that inclusion rate, whether it's 50 or 2/3, will not apply. 100% profit on the sale of that property will be included in income. Except if there are certain life events that force the sale upon you. What are those life events? Death of a taxpayer, household change requiring a move, perhaps a breakdown of marriage, etc. Won't get too much into these details, but just wanted to remind you that these rules is not capital. It's deemed to be business income unless one of these life events come into play. Okay. Real quick, you might be wondering, why are we talking about how long we keep our books and records? Well, many times throughout the year, we're asked how long we need to keep the books and records. And the standard response is 6 years, you need to keep them from the date you last filed the return. However, we always at the same time remind our clients that certain properties that we hold for long terms, such as capital property we're talking about today, you do have to keep the evidence of the purchase document. So you may have purchased the item 10 or 15 years ago, but just because 6 years have passed doesn't mean that you can dispose of it. You still need to be able to produce the evidence to the CRA if you are audited for that transaction. So please always remember that the books and records, the standard, 6-year rule does not apply for those items such as these assets that are held long term. Okay. And just one little reminder about installments. In years when we do dispose of capital property and we incur, these large capital gains, installments at first will be triggered to request significantly more taxes from you during the year. But if it's not going to be another year where you're selling another large property, you do not have to remit all those installments, but beware any shortfall in installments, you would have to pay interest, which these days is quite high at 10%. Okay, then, so I'm going to stop sharing and Paul is going to take over the controls and do the second half of our presentation.
All right, hello everybody. Can everyone see the slide on the screen?
Yep.
Perfect. Okay. So yeah, I'm going to take over now to talk about the tax planning considerations. I think the big burning question on everybody's mind is, well, with this proposal, what do we actually do going forward? I think it's important to keep in mind that this is still a proposal at this stage, and we have not yet seen draft legislation, as I mentioned. So as a tax planner, we're dealing in an environment of uncertainty. We don't know for sure what will come into place and when that will happen. But at this point, I think it's prudent to go on the basis that the proposal will come into place. And as of June 25th, there will be a higher inclusion rate on capital gains, as Barbara has been discussing. But we don't know for sure that that's ultimately what will take place or when it will take place. With that being said, I think the burning question on everybody's mind is, should I do something today? Should I sell my capital property, my investments, or my real estate to take advantage of the 50% inclusion rate now? Or should I continue to hold on and keep that tax deferral in place going forward? And we end up with a little bit of a battle here. We end up with a tug of war between tax savings by selling now at lower tax rates, or tax deferral by leaving the tax unpaid until a future date, but potentially suffering higher tax rates at that time. Right now, using top marginal rates in Ontario for an individual, with a 50% inclusion rate, capital gains are taxed at a little bit under 27%. With the 2/3 inclusion rate, that goes up to about 35.7%. So there's a jump of about 9% in capital gain tax rates. For those who are in slightly lower tax brackets, the increase is a little bit less. We know that for individuals, there is the $250,000 cushion where we keep the 50% inclusion rate. So we know at a minimum, the individuals who are affected, if you have more than a $250,000 capital gain, then we know your income would be at least $125,000 for the year with the 50% inclusion rate. So further capital gains over and above that are subject to the 2/3 inclusion rate could be taxed starting with income at $125,000. So we know this won't hit low income individuals at all, but we may see some people hit who are not quite at the top marginal rate. And the increase in capital gain rates because of the inclusion rate for someone with $125,000 of other income is between 7 and 8%. So just slightly less than this figure here. So how do we compare the two options: paying less tax but now, or more tax but later. Well, I think what we do is we look at the tax cost today, and then we look at the present value of the future tax cost. The idea with present value is that paying $100 in 10 years is not as painful as paying $100 today. So the $100 in 10 years really effectively costs us less money today. And the way we calculate that is by using a discount rate. And the discount rate, I think that's where some thinking needs to be done in your own situation. The concept is that the discount rate effectively tells you what your money would do for you if it were to remain invested and not used to pay tax dollars today. So in my way of thinking, we need to use a discount rate that is equal to the expected after-tax rate of return on the dollars that you'd otherwise use to pay taxes if you trigger a sale today. So it's the after-tax return on your investments, essentially. When I think about that, I think it's reasonable for the general populace to perhaps use an after-tax rate of return of about 5%. I think you'll want to consider that in your own situation, whether that's an appropriate number or not. But if we use 5% as the discount rate, what we find is that if we pay the tax today, in this case, we've got $1 million capital gain, the top marginal rate, we'd pay about $267,650. The present value of paying the higher tax bill with the 2/3 inclusion rate would fall in about year 6. Basically, what this is saying is that the lower tax rate of paying today is worthwhile if you might sell in the next few years, and say in this case in the next 5-6 years or so. If you are going to hold that asset anyways longer, then the tax deferral of waiting to pay that tax bill is more valuable than the tax savings over a longer period of time. So essentially, we're looking at the idea of when you might sell anyways being a real driver as to should you do something now. There's no sense paying tax today, even at a lower rate, if you're holding onto real estate for another 30 years, for example. But if you're going to sell next year and possibly be subject to a higher tax rate, well, maybe it makes sense to trigger that before June 25th. So how might we do that? Well, you can sell investments in the open market and just as you would at any time, but sometimes you hold assets that you don't really want to give up. So one of the things you could look at is the crystallization of gains by selling to a family member, a trust, or a corporation. There's not a whole lot of time left to be able to do something like this, so you kind of have to scramble to get something done. But you could trigger capital gains by selling assets to those around you, whether an individual or another entity, where you're not actually giving up the use of that asset ultimately. So it could be spouses selling to each other, selling to children, or selling to trusts or corporations that you set up. But there's some non-tax issues to consider. If we sell investments, we may be giving up the cash flow or investment income that comes from that asset. So triggering capital gains just to get a low rate might cause a detrimental effect just in terms of the income that the investment provides separately from the growth. Is it a good time to sell from a valuation standpoint? Is this an appropriate time to sell marketable securities? Can you even arrange a real estate sale fast enough? And is the value appropriate that you would want to take advantage of crystallizing now? With real estate, there could be loss of use if you sell to a third party, or loss of control if you sell to somebody within your family. And likewise, with private corporations, if you're selling shares that you own of a company that you run, there are implications around control, and those issues may be far larger than just this change in tax rates. Over a little bit longer term, I think an important question is, should I change how I invest? For the last number of years, we've been very much pro capital gains in terms of building portfolios return that provide the return in the form of capital gains rather than other sources of income like interest, foreign income, or dividends. With the increase in the inclusion rate, capital gains is still taxed at lower rates, but it's getting closer to what eligible dividends provide. So we can see in the brackets for individuals where this new inclusion rate might take place. The existing rates fall here, and with the new inclusion rate, it would jump up, as we can see at this point. So we're still looking at capital gains being preferable, but relatively speaking, not as much as they have been. So my thought at this stage is stay the course. Capital gains are still preferred, unrealized capital gains even better, where we can leave investments intact and allow them to continue compounding. But be mindful that growing unrealized capital gains could cause you to exceed the $250,000 cushion if you trigger a sale all at once. So we may be thinking that you might want to trigger capital gains on an annual basis, keep bumping up your adjusted cost base, keep getting that 50% inclusion rate, as long as you're not triggering gains far earlier than you might otherwise. There really isn't much that can be done with real estate in terms of triggering gains slowly, unless perhaps you are selling off pieces of real estate or percentages of real estate to other family members. But typically that's an all or nothing type proposition. So I don't think there's a whole lot we'd really be overly concerned with on that front. Now, a few points for those who are business owners who have investments inside a corporation or other capital property. There's two layers of tax that apply. So this first chart looks at just the capital gain taxation that occurs within a corporation. So in this case, we've got a $200,000 capital gain, either subject to the original 50% inclusion rate or the new 2/3 inclusion rate. You can see the taxable capital gain. And then within the corporation, we have non-refundable and refundable tax. Refundable tax is paid initially by a corporation to prevent any unwanted tax deferral. And I say unwanted, it's unwanted by the government, not by us. That refundable tax is paid back to the corporation when the corporation in turn pays out dividends to its shareholders. So it's a temporary tax that's recovered and replaced by the personal tax when that gain ultimately gets dividended out. And the non-taxable portion of the capital gain gets added to the capital dividend account inside a corporation, and that's available to be paid out tax-free. With this new inclusion rate change, we go from including half of capital gains in the capital dividend account to including 1/3 of capital gains. So there'll be less available that can come out tax-free with this new inclusion rate. When we layer in the tax that applies to the individual who then strips that gain out of the corporation, we can see that the difference now is close to 10%. So this inclusion rate change really hurts business owners more than anybody else. The difference is a little bit higher. So we go from what used to be about a 29% total tax cost to about a 39% total tax cost for those individuals who are in the top marginal tax bracket. So that's a pretty significant increase. But again, it's still less than any other forms of investment income. Another point to consider is for business owners, where should we be saving? We have favored TFSAs primarily, but the limits are so low that only accomplishes a very little bit in terms of saving surplus. So then we next look at corporations and RSPs. And over the last decade or so, I've certainly been a proponent of corporate savings over RSPs in a lot of cases. If we can invest on a reasonably tax efficient basis inside the corporation, we're able to get at that money at cheaper rates than we get at registered funds. And there's far more flexibility with corporate savings. There are a number of tax planning tools that are available, and there's no minimums required to take out as there are with RSPs when you convert to RIFs. So historically, I've definitely liked corporate savings probably ahead of RSPs in most cases. With this rate change, we need to rethink that. And we don't yet have final answers. We haven't crunched all the possible numbers to look at this. But fair to say that we may favor RSPs compared to corporations more so than in days gone by. And then the last place we look to save is personal non-registered because that's taxable. But we will have to think about that a little bit because corporations have the 2/3 inclusion rate and individuals, the first 250,000, we still get the 50% inclusion rate. So there may be some focus on getting some dollars out of the corporation to invest in a personal non-registered basis if we can get the money out of the corporation at low enough tax rates. For owners of corporations, when they look to sell their businesses, previously, an asset sale where a corporation sells the assets it owns versus a share sale where the individual sells the shares of the corporation that owns the business assets, we were relatively indifferent in terms of tax efficiency if we exclude thinking about the capital gains exemption. But with the change in inclusion rates for corporations, we now would definitely favor share sales, even where the capital gains exemption may not be available. So that's a big change in how we've thought about things before and may drive how you look to transition businesses in the future. We should also think about estate freezes. An estate freeze is where an existing owner of a business gives up the future growth in the value of the company by changing their common shares to fixed value preferred shares and allowing other people, typically other family members, to subscribe for new common shares that represent the future growth in the value of the business. That estate freeze may have the effect where when that company is ultimately sold, more people are participating in the capital gain on the sale of the business. That gives us access, one, to more capital gains exemptions, and two, more of the $250,000 cushions and the lower inclusion rate. So we definitely will be thinking about estate freezes even more than before. Some further planning considerations, I've mentioned this already, for individuals, should we trigger capital gains on purpose to use our $250,000 threshold? We have to think about alternative minimum tax. This is a concept not everyone is familiar with, but applies across the board. Every year when you file your tax return, the tax software actually calculates your tax liability in two different ways. There's the regular method and this alternative method. And the alternative method is designed to counteract somebody who's claiming too many tax preferred items. Capital gains with a 50% inclusion rate are sensitive to alternative minimum tax. And if the alternative method of calculating tax results in a higher tax liability than the regular method, the difference between the two is considered alternative minimum tax, or AMT, paid for the year. And if in the future the regular method is higher than the alternative method, then that difference can be recovered. So AMT may arise in years where you trigger large capital gains, or in particular claim the capital gains exemption, but it's possible to recover that AMT in the next 7 years. An interesting effect of this capital gain inclusion rate change is capital gains may be less sensitive to AMT. It's a higher tax bill, so it's not a great story, but with a 2/3 inclusion rate, there is less alternative minimum tax that gets calculated because the regular calculation results in a higher tax liability. And the last point I want to mention is consider permanent life insurance as an investment vehicle. This is one of our last bastions of tax preferred savings. And it's not something that necessarily applies to everybody across the board, but where you've got surplus assets that you know you won't need in your lifetime, it's possible to structure permanent life insurance where you can invest and have the investments grow tax-free. And when you pass away, it can pay out tax-free or mostly tax-free. And that is, those are some tax benefits that really aren't available in too many other places other than your TFSA. The big hitch with life insurance is that it doesn't pay out to you. So this is great for those you leave behind, but it's not something that benefits yourself. But we can always talk to you about whether or not this is a fit in your own situation. In conclusion, I think it's important that you seek professional advice in this area. It's a complicated world, getting more complicated by these proposals, and we will certainly be happy to assist and provide advice to help get you sorted out. So with that, I think we're at the point now where we will take some questions.
Okay, I have a question here from John. And I think, Paul, you will be able to answer. Great question, John. I mentioned when I was chatting that individuals will still benefit from the 50% inclusion rate on the first 250,000 capital gains. Paul, will this 250,000 exemption also apply to graduated rate estate trusts?
Right now, the proposal does not contemplate any special rules for graduated rate estates or qualified disability trusts. Those are the two types of trusts that get their own marginal tax rates, where other types of trusts are subject to tax at the highest rate. So at this point, the proposal has been silent on that issue, meaning that we would expect graduated rate estates to be subject to the 2/3 inclusion rate, the same as any trust. Where trusts distribute capital gains to individuals, we expect that the $250,000 cushion will apply to those individuals. But again, we're waiting for legislation to be drafted and finally enacted before we will actually know what the situation is with certainty.
Okay, great. And I guess if I just think about our slides and our presentation, as many individuals and taxpayers are thinking, should we sell now or later, if we have the option. And so what our slides were saying is that if the 5% after-tax discount rate is applicable, and you were going to sell before 5 years' time anyways, then it could make financial sense to sell before June 25th.
Yeah, that's right. And I think what's important to keep in mind here too is that the earlier you might sell, the greater the benefit. Where if you're going to sell in 5 years, deferring till 6, right? There's a marginal difference, right? But selling in year 1 versus year 6, there's a greater difference. So the biggest benefit from selling early comes when you might have sold soon anyways. And that benefit declines over time. Likewise, the benefit of tax deferral is greatest the longer you leave the investments intact or the capital property intact. If you're going to sell in, say, 7 or 8 years, there's not much difference ultimately to your economic picture if you do that versus if you sell now and take advantage of lower rates. So that benefit, that break-even point, the benefits are close either way when you are close to that point, and are greater at the extremes away from that break-even point.
I think, we saw, I'm just looking at the questions. I don't see any new questions yet. We saw with the trust rules, how they changed. And then at the nth hour, at the end of March, it was no longer applicable. And we did not have to file the new information that was requested of trust in regards to the held in trust accounts and other items like that. And then the underused housing tax returns that were originally due a couple of years ago, and then it was deferred to October 31st. At the nth hour on October 31st, it was April 30th. And now here we all are rushed, and all taxpayers are concerned, and June 25th is now less than a month away. I wonder if, on June 24th or even June 25th at 5 p.m., we're going to find out that it's been extended until August 31st to give taxpayers enough time to plan. Yeah,
it's certainly possible. There have been a number of proposals that took years longer to come into place than originally thought. I know there are a number of lobbying groups pushing for January 1st, 2025 to be an
Right.
appropriate date. We'll see what happens. The fact that we don't have draft legislation yet makes me wonder, will this happen for June 25th? But
Right.
again, we don't know, and we're guessing. And if you really want to do something, I think plan to meet that date, because if you miss it, it might possibly be too late.
Right. I also wonder, we always see, in the year of death, there's certain additional deductions available, or different rules apply to taxpayers that are deceased. I wonder if that will, also become part of the legislation, some special rules. But like you said, I guess we'll wait and find out.
Yeah, I think one of the other things that's happened historically that I wonder about, in 1994, the $100,000 lifetime capital gains exemption for all types of property went away. And the government gave people an opportunity to crystallize gains and use up the exemption at that time. So I'm wondering if the government will provide some easy method of crystallizing, saying gains up until such and such a date, get a fair market valuation done,
Right.
and get the inclusion rate up to that point.
Mm-hmm.
I haven't heard that the government's going to do anything, but it makes me wonder. So,
Yep. Yep. We have a couple more questions, Paul.
yeah,
Can you see them there, or?
yeah, I've got them here. Yeah.
Okay, I'll let you.
So a question from Brian about joint partner and alter ego trusts with jointly owned real estate. Can the gain be split between spouses? With reporting capital gains, the important issue is beneficial ownership of the assets. So beneficial ownership refers to who has the economic entitlements, despite what the legal ownership might say. So if both spouses contributed to the purchase of the property, then they'd be able to split that capital gain based on their relative contributions. If one contributed all the money, but both of their names are on for legal purposes, it would just be taxed in the name of the person who contributed the funds. With respect to joint partner and alter ego trusts, I think we still have the issue that we don't believe there will be the $250,000 cushion on the inclusion rate for gains triggered inside trusts such as those. So I guess more to come on that front when we get actual rules. But as much as I've read so far and heard others speculate on, I think the gains can be split when beneficial ownership is joint. But for joint partner and alter ego trusts, there may not be that $250,000 cushion. I see a question from Dino. Selling property, land at this point would be a challenge because of the timeline. Definitely, I agree with that. Is it better to sell within the family? Father owns property, sells to kids before the date. Is that advantageous? I think it could be. It could be a way to get the gain triggered with the lower inclusion rate still applying across the board. But there are broader implications. Does father really want to give up that land? Is now an appropriate time for kids to take over as owners? Do kids have the funds to be able to pay dad for that property, or does dad need the money for kids to do that? Father gives up control of that property if it's sold to kids. So I think there's lots to think about in terms of just the change of ownership and the effect that it has beyond the tax bill itself. If you're comfortable with all of the other issues and it's a way to trigger tax at a lower rate if you are going to sell that property soon anyways, then I think that could absolutely be advantageous. If you're doing this now, but you might hold on to that land for another 20 or 30 years yourself, then I think you're giving up too much tax deferral to get that low rate by paying tax now. So yeah, I think hard to say that it's just blanket, it's advantageous. I think under certain circumstances it could be, but you need to make sure your fact pattern fits with that kind of thinking.
Okay. I do not see any other questions here? It's 2:20. We're scheduled until 2:30. We'll see if anyone else.
I guess we answered everyone else's questions.
Mhm. I guess this is what happens when it's just a proposal. Maybe there's just too many questions.
Yeah, I think stay tuned for
Yeah.
further details when we actually get more specifics and
Absolutely.
can answer more of those. We'll obviously work to keep you posted as we learn more ourselves.
Mhm.
Until further notice, though, assume that the June 25th date is a go and that these changes will take place. I think that's the best advice going forward right now.
Mhm. Okay. Well, thank you very much. On behalf of McVean Tax Professional Corporation and BDCA Chartered Professional Accountants, we are here for you. Thank you for your time, and we'll be in touch soon. Bye, everyone.
Thanks, everybody.
Bye-bye.
Thank you.